So I'm here today with Jake McPherson. He's one of our favorite lenders, and he is with First Community Mortgage. Hi, Jake.
Hi, how are you?
I am good. So, Jake, one of the things I wanted to talk to you about is, and we've used this word to describe the market probably for the last 3 years, it's a crazy market, right?
Yeah.
But the craziness right now at the end of 2023 is a different crazy than it was in 2021, right?
Yeah, whole different set of obstacles.
Let's talk about, first of all, what are some of those obstacles right now? The elephant in the room, is interest rates, right?
Say, for most people, it's going to be interest rate.
Let's talk to that first-time home buyer that is saying, I'm waiting for that interest rate to drop. What do you say to that buyer?
So it's a loaded question only because when interest rates tend to drop, which there's a lot of different factors that can cause interest rates to go down, is every time interest rates drop, there tends to be more demand. Currently right now, they're saying if interest rates even drop 1%, that will bring about around 5 million more buyers nationally back into the market. We won't even sell 5 million homes in the market this year. So relatively, you're doubling the amount of buyers that are interested in going out there and looking for a new home, which just brings about competition. Competition, prices go up.
And we've seen that now, and you and I have talked about that with Dave. There is a nationwide shortage of construction, period.
Mm-hmm.
So I think a lot of people don't realize they're waiting for 2008 to happen.
Yeah.
But that was a very different market.
It was a different time, different market. From just a lending perspective, regulations were a lot different.
You could get a loan for practically anything in 2008, right?
If you had a pulse, you're probably getting a loan. Nowadays, we do a lot more vetting through documentation, making sure they can repay. So we're just not seeing the uptick in foreclosures that we were seeing in 2008. Foreclosures put a lot on the market then, which then allowed it, less competition,
right?
Supply, demand. It really brought out a ton of supply with little demand. Right now we have the opposite problem. We have no supply and a ton of demand.
So what do you say to, and I'm talking specifically to the first-time home buyer right now, because it is tough, and we acknowledge that.
Sure.
Prices are still high. You've got high interest rates, higher than we've seen in years.
Yeah, 20 years.
What is your recommendation to that buyer?
So you always want to make sure you're comfortable with your monthly payment no matter what don't stretch yourself so thin where if rates don't ever come down, you feel the pressure of trying to make your mortgage every month.
Right.
And
not able to be house poor.
Yeah, not able to do anything else, eating ramen out of a bowl.
Right. That's for college.
Yeah. So what I always tell them is make sure you're comfortable with the house payment, but it's pretty interesting. The difference between, a $500,000 house at a 7.5% rate and a $525,000 house at a 6.5% interest rate, it's the difference in payment of about $300, give or take. Now, in that situation, if you were to be the person that bought at the $500,000 price point with the 7.5, if you then go and refinance to the 6.5 that the other person waited to get,
right,
you end up being about $150 cheaper a month than the person that waited because of the house price difference. And then you missed out on the house price going up, which is, $25,000 of equity that you're not getting.
Right.
And that's using a conservative estimate of, 5% a year, which according to all of the economists, 2023 and 2024 should have about that same increase in pricing.
There are some different programs available for first-time home buyers or buyers in particular. Can you talk about what some of those programs are and what are some different options?
Sure. First-time home buyer programs that are out there, their benefit of those is they require less money down. So even though home prices have gone up, your amount of down payment hasn't increased maybe as much as you would think a home price has increased. If a home price has gone up $50,000, you're only bringing 3% of that $50,000 difference. So it's not like you have to bring $50,000, which is nice.
Yes.
Then they also do have beyond that, with first-time homebuyer programs, they have usually slightly lower interest rates, slightly lower mortgage insurance, which for those of you who don't know, mortgage insurance is when you don't have 20% down to put down. So all of those savings through slightly lower interest rates, savings on your mortgage insurance, it allows you to get into a home cheaper than somebody else who's maybe not a first-time homebuyer.
Right. And we've talked about that slogan that probably started about a year ago, marry the house, date the rate.
Yes.
What does that mean?
Well, so interest rates over the last 50 years have gone up and down. That business is very cyclical in nature. It tends to always go up and down and fluctuate. It's very hard to time it where you're always going to get the lowest interest rate, or you're stuck with your higher interest rate for the time being, because at the end of the day, as they go up and down, if you own the house, you have the ability to change the interest rate. And that's really the goal. Find the house you love, get into that home, and then it's all about staying on top of, timing the market to get the next interest rate potentially lower than what you had when you bought it.
Well, and one of the things we're seeing right now with the market where it is the fact that a lot of buyers are able to negotiate in a way with sellers that they have not been able to do in a very long time.
Yeah, if you remember COVID,
yes,
there was no seller concessions or seller credit to help you with down payment or closing costs or anything like that. It was the opposite. It was,
I'll give you $15,000 over.
Yeah, please just take my offer.
We'll waive the appraisal contingency,
yes.
All those things.
Yeah.
So that is right now a real opportunity for buyers. And there are situations that as we've discussed, where they can buy the interest rate down. Mm-hmm. And to do that, they want to use some of the concessions from the sellers, correct?
Yeah, so there's two different types of buy downs out there. There's a permanent buy down, which you can do yourself or a seller can pay for. So it allows the flexibility if the seller's not willing to give you any sort of seller credit, you can buy your own interest rate down. And there's a formula that I like to walk people through to make sure it makes sense in the long run versus just doing it because you think it makes sense. The other part of that is the temporary buy down option. Now that's the one where we tend to see a lot more of those in a high interest rate environment.
That's what we call an ARM, correct? An adjustable rate mortgage?
No, it's separate.
Okay.
So, and you're you're still in a fixed rate loan. That loan will not change.
Okay.
It's similar to an ARM in that the interest rate will change based on how much you buy it down.
Okay.
And so there's four, for us personally, there's four different types of buy downs. There is a 1 year, 1% buy down. There is a 2 year, 1% buy down, where it's 1% the first year and 1% the second. There is a 2-1 buy down. So in the first year, it's 2% lower. Mm-hmm. In the second year, it's 1% lower. And then in the third year, it's the current interest rate. And then there's a 3-2-1 buy down, which is a 3%, then a 2, and then a 1%.
And that is a lot to take in. It's very confusing. And that's where somebody like Jake will sit down in your personal situation, run the numbers, go through different scenarios to see what makes the most sense for them, right? Because it's going to be different for different buyers.
Very much so. And a lot of people are like, oh, this is new, and what does that mean for the market? It's been around for really long. Temporary buy downs have been around for 50 years.
Really?
It's just they weren't very common when you weren't in a high interest rate environment. And now we're back in a high interest rate environment. And so the reason behind doing something like that is it will allow you to have a slightly lower interest rate in the beginning to give you time for interest rates to come down and then hopefully refinance into something more permanent at a lower rate.
And if they don't come down, you've gotten lower rate.
Yeah, you've gotten lower rate, and hopefully over that course of time, you're making more money. The payment feels a little bit comfortable. There's a lot of things that can happen during that time that'll also make the payment more comfortable if the rates don't go down.
So we talk about closing costs, and especially for someone that doesn't have a lot of experience in purchasing homes. Maybe it's their first home, or maybe it's been 10 years since they bought a house. What all is encompassed in closing costs?
So
we talk about that.
It almost feels like a trick question because it depends on who you talk to.
Okay.
So there is closing costs, which are relatively the cost for the transaction.
Okay.
That's going to include here in Georgia your attorney's fees, because Georgia is an attorney state.
Right.
So you're going to have your attorney's fees. Then you're also going to have your homeowner's insurance premium, which is your first year of homeowner's insurance, and then some prorated property taxes, along with the lender or investor's fees. So
Title insurance in there as well?
Yep, that's under the attorney's fees section. So there's relatively 3 parts is what I tell people for your closing costs. Your bank or investor's fees, your escrow setups, which is your homeowner's insurance and property taxes, and then the last one is the attorney's fees. Now, depending on who you ask, some don't count the second one. Some leave the taxes and insurance out of it because that's relatively your money being put away on your behalf. It's not a cost of the transaction. Only the first 2 are the cost of the transaction.
Okay.
I like to include them all because at the end of the day, you're bringing them to the table no matter what. So you might as well know that they're all part of coming to a closing table and purchasing a home.